Gold is going to continue to outperform because the big players with the big money are going to keep stacking gold. They don't have the storage space and they have hundreds of millions to hide. They have to buy way too much silver. And more importantly, the people that do this are the insider cartel. They need silver to be available for solar panels and everything else. You are in a suppressed silver market when the big money is going to chase gold, or the retail money is going to chase silver, trying to jump to the next phase because they were late for gold. And they should stay playing phase one until it's official that phase one is over. Phase one is over is when the gold silver ratio reverses, and it's confirmed when it breaks 75 down to the downside. We are going in the opposite direction. You should continue to play what you see, and that is stacking gold.
FrancisHunt, a veteran market watcher with 3 decades of experience, believes the gold-silver ratio still has room to move higher before silver truly takes the spotlight. According to Hunt, the ratio could climb into the 170s during a major financial blow-off event, as such moves often happen with remarkable speed. The gold-silver ratio, a key metric closely followed by hard asset investors, remains a critical indicator. As of Wednesday, 1 ounce of gold was priced at about 98 times the cost of an ounce of silver, slightly lower than earlier in the week but still well above the 30-year average of 68. This wide gap continues to suggest that silver remains undervalued relative to gold. During the initial market panic triggered by COVID-19 in March 2020, the gold-silver ratio spiked to 113, after which silver surged 73% over the following year, while gold posted a modest 8% gain. A similar pattern unfolded after the 2008 financial crisis, when the ratio jumped from 53 to 80 in 5 months, followed by an 81% rally in silver, significantly outpacing gold's 44% rise. Even the brief market scare in early 2016 saw the ratio exceed 80, again followed by strong silver outperformance. These historical precedents reinforce the view that silver tends to deliver its best gains after extreme gold strengthening periods. The gold-silver ratio has reached short-term resistance around the 105 level and is showing signs of a correction. This level is significant, matching the historical peak seen in February 1991. The pullback suggests growing investor interest in silver relative to gold, with silver gaining faster. A decisive break above $35 in spot silver would be a strong technical signal, indicating a potential surge in the silver market. Hunt advises caution, noting that until the gold-silver ratio breaks below 75, the more prudent strategy is to stay heavily invested in gold. However, once that breakdown occurs, he plans to shift aggressively into silver. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold is without doubt the best thing you can have right now. I'm not ready to go overweight the miners. I have some miners and I have some silver. Here's a controversial opinion I'll share with you as part of this, and I'll just bring this in. But I need to show one more chart before, and that is that people have pivoted too strong to silver too soon. Everybody goes, oh, I know this movie, and silver wins much more in the end, and they rush into silver. This is going to be a far larger extended cycle. So if we go to the gold-silver ratio, I was just mentioning it, we feel that in actual fact, gold-silver ratio is going to extend right the way into the 170s, and in a possible blow-off moment, because we typically get over performance, this is how you go up when you're in a blow-off moment. It's just like ridiculous amounts all of a sudden in 3 candles. We're on a fortnightly there, so that would be 6 weeks. You just shoot, you literally were 1 minute you're at 89 and then you're at 126. It's like, wow, how did that happen? 30, literally in 6 weeks. And that's just violent move. It's our opinion that not enough people, you see, no one's really a macro technical analyst. No one makes these calls. It was the same for us when we called single digit oil and the turn in the bond markets. It's a crazy thing to say. It's the end of the bond cycle when we said it. Now it's commonly accepted wisdom. It was a crazy thing to say single digit oil and you should be going long gold, short oil when we said it. Because everybody was inflation trade, oil's going to go up, all of that sort of stuff. No, consumers getting wrecked and shutting everybody down. Very bad for oil price. We didn't know what was going to be the story. We just got the technical trade. That's why we're earlier than most people. And most people are not going to make this. And let me just be clear. There's going to be silver bulls. I'm a silver bull. Here I am. Where's my coin? It's somewhere here. And I am in silver, but I am stacking gold more aggressively. There's my silver. And I'm stacking because it's going to extend, in my opinion. Why? Because this is the biggest meltdown you've ever had. You've never seen it. Everybody thought shutting the world down is how do you top that? This is a bigger crisis in terms of the financial aspects. We've seen that most times you got to 90, the silver ratio sold off. It's only in the big crisis you did that. This is the big crisis, and this is just starting, and gold is going to continue to outperform because the big players with the big money are going to keep stacking gold. They don't have the storage space, and they have hundreds of millions to hide. They have to buy way too much silver. And more importantly, the people that do this are the insider cartel, the banking cartel. And they want cheap silver a little bit longer for the military industrial complex that has 5 kilos of missile, for the Tesla battery cars so that they can surveillance finance you and check where you are and take over the car, auto drive it to the police station because you committed some social crime on Twitter, etc., etc. They need silver to be available for solar panels and everything else. You are in a suppressed silver market. It's a small enough market that can still be bullied a lot more, and the big money is going to chase gold. The big money is not going to chase silver. The retail money is going to chase silver, trying to jump to the next phase because they were late for gold. If they were following us, they weren't late for gold, and they should stay playing phase one until it's official that phase one is over. Phase one is over is when the gold silver ratio reverses, and it's confirmed when it breaks 75 down to the downside. We are going in the opposite direction. You should continue to play what you see, and that is stacking gold. By the way, that doesn't mean I'm bearish silver. So the comments are going to say, oh, it's bearish silver. I don't like him anymore. I'm a silver stacker. It's affordable. Listen, gold's affordable. If you buy 1 gram, it's $100. If you can't afford $100, think about, what you're doing for income. That's a different problem, and we can talk about that separately. So gold should be bought now for the outperformance it offers. It's going to extend in our best view a lot higher. Then once it turns, on my DCA, I go 100% silver. So if that's up here and we just run the 171 and we get that slam down like that, right here, I go from buying 75% gold, 25% silver to going 50-50. And when we break 75, I go 100% silver to the downside, which will be somewhere around here. So this is something that's really important.
The International Monetary Fund has sharply downgraded growth forecasts for the United States and other advanced economies following the recent volatility caused by major shifts in U.S. economic policy under President Donald Trump. While the turmoil in financial markets and the uncertainty surrounding global trade have already affected business and consumer confidence, the bigger question remains whether this will be enough to push the global economy into a full recession. The IMF notes that global growth has already been impacted as diminished confidence reduces spending and lowers investment levels. Furthermore, disruptions to global supply chains and rising inflation, fueled by increased tariffs, will cause further economic damage in the coming years. Although the IMF predicts a significant slowdown in global growth for 2025 and 2026, it stops short of forecasting a recession, at least for now. However, the risks are rising. The probability of a global recession has climbed from 17% to 30%, while the likelihood of a recession in the U.S. has increased to 40%. According to Hunt, years of over-leveraging the financial system, relying too heavily on debt and unsustainable monetary practices, have left the U.S. economy vulnerable. He points to the bond market as clear evidence of this shift. Once considered a pillar of global financial stability, bonds are no longer seen as a desirable reserve asset, a fundamental change that signals deeper structural problems. Let's get back to the interview.
This is not 1987 where Greenspan can cut the rates and reflate. It's not 2000 where dot-com boom, you can supercut rates and reflate. It's not 2008 and 9 where you can cut rates and then do QE 1, 2, 3, grind along the bottom for quite a long time, but eventually create enough heat with proliferation that you manufacture some kind of recovery. It's also not 2020 where you then threw trillions, as never mind cut rates, which was peak bonds, the blow off technically in rates, in valuations, and the capitulation in rates right down to 0.33, where you threw everything, including 7 trillion into this. You don't have that option anymore. The bond market turned. That call is good. Nobody wants it as a reserve asset. What everyone needs to understand, the USD comes with a UST. It's borrowed into existence. You should think of them as a pair. Gold doesn't have a pair. It has no associated liability. But what you're seeing is home brokers are not wanting to originate new home loans. A, they're charging more in spite of the interest rates actually being at somewhat lower. And B, they're refusing 43% of loans. Why aren't they wanting to originate debt? Because somebody else has to buy that as an asset and there's no longer the demand for it. Or they have to sit with it on their own book and say, how good is that asset, the home market, given that we're in a hypervalued property market, hypervalued stock market, and we're in a collapsing bond market. And now add into all of that, there's 9 trillion in rollovers to be done. So anybody who thinks you're going to get QE, hold on, you've got this 9 trillion to find a home for. Otherwise, you've got to pay all of it off, which nobody can do, not America, not anyone else. So you have to put it out again, and it's going to be put out at much higher rates, even if we have a rate cut or two in the next few months. So your interest bill's going up. Right now, your boomer demographic, which is like an inverted pyramid, welfare, Medicaid, and Medicare are all going up. Everything's going up. The unfunded, those were the primary unfunded liabilities, which many have estimated actuarially could be 600 trillion. And it is part of the reason why I think we had CV19 and the first people were the elderly to be, let's just say, retired early. And it's part of it is the pension problem in European, particularly white European nations, which seems also to be the worst hit. It's fair to say that we passed peak America, and that is unfortunately a factor of the abuse of the base layer of borrowing money into existence. Everything else, stock markets and their valuations, all sit on top of that. You first have to have a point system, which is money and debt. That is the foundational layer. You've borrowed too much. So in terms of how I say, how do you become rich? I say, well, Jesse, here's what you need to do. You live within your means. You earn more than you spend. You basically produce more than you consume. Another way of saying the same thing. You invest smartly with the surplus, such as buying gold in this time. Not every time. I'm a massive gold bug now. I'm not always. There will come a time where I will trade gold for other assets. And that's how you get wealthy. That's what China is doing. They produce more than they consume. They have trade surpluses with the world. Everybody gave up manufacturing because they could get slave labor wages out east in many of the countries there and live the life of Riley and say, hey, put it on my credit card. We don't have a black Amex with a bottomless limit anymore. America had its bottomless overdraft changed. Here's the limit. You got a limit here now. Now suddenly you've got to make hard decisions. Things have to go down. So everybody who's been saying there's a melt up still to come, they're living in this 1987. We're just going to keep ad-libbing the cycle. You just keep adding, bigger amounts in each QE, cutting the rates, bigger pump, etc. No, because the system that allowed that now is broken. That allowed you to put out the fires is broken.
The shifting tides in global finance are painting a complex picture for precious metals and economic stability alike. While gold remains a cornerstone for cautious investors, historical patterns and emerging technical signals suggest silver could soon step into a leadership role. Meanwhile, the broader economic outlook grows increasingly fragile as weakening confidence, strained supply chains, and mounting debt concerns challenge the resilience of major economies. As financial structures evolve and traditional safe havens are reassessed, precious metals and global markets stand at a pivotal crossroads. Could silver's brewing momentum coincide with deeper cracks emerging across the global economy? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.